Hello everyone. Today we are going to look at accounting equations. So I'll explain this accounting equation through an example. For an example, if we take when a business starts, the very first transaction is the owner will invest some money into the business. When owner invests some money, from the business perspective, the business will receive money. From business perspective, cash will come into the business. So we know for the business, cash is increasing. At the same time, owner will have ownership towards the business. So here I have taken small example. Owner invested $100,000. From the business point of view, cash will come into the business. So cash will increase by $100,000. At the same time, the owner will have 100,000 worth ownership towards the business. Cash is considered as an asset, ownership is considered as a capital. So we can say asset is equal to capital because business cash is increasing by 100,000. At the same time, the ownership towards the owner is also 100,000. So 100,000 is equal to 100,000. Cash is an asset, capital means the ownership. So asset is equal to capital, we can say in this example. So now when the business evolve, the capital alone will not be sufficient. So the business may have to take a bank loan. Let's see when the business take a loan, how will the equation affect? I'll continue it from the same equation. So here the business is obtaining a loan worth $50,000. So from the previous transaction, we have 100,000 cash is equal to 100,000 capital. So when business takes a loan, the owner will go to a bank. When the loan is approved, he will receive cash worth 50,000. So $50,000 worth cash is coming into the business. So cash is increasing. So cash is increasing mean in this case cash is an asset. Asset will also increase. At the same time, business has an obligation towards the bank to pay back that 50,000. So at the same time, cash is also increasing. At the same time, a liability also increasing because bank loan is a liability. So if we say earlier, business received 100,000 from its owner. So cash increased by 100,000 from 0 to 100. Now the business received 50,000 from the bank. So another 50,000 increased. So total asset is 150,000. At the same time, the business has ownership of 100,000 and bank loan of 50,000. So we can say asset is equal to capital plus liability. So this is the key formula we have to remember. This is very, very important. So now we have learned asset is equal to capital plus liability. So we can change the subject of the formula and rearrange it. So we can say capital is equal to asset minus liability, or we can say liability is equal to asset minus capital. So this is just a matter of changing the subject. Here the capital means the amount owner invested, the owner's ownership. And the liability means a third party, an outsider has given some money or resources to the business. So it's our obligation to repay. From the business perspective, capital and liability both are obligation. Capital is the obligation towards the owner and the liability is obligation towards third party. So we can say capital is internal capital, which is very straightforward, and we can call liability as external capital because it is funded by a third party. So now I'm going to take you through a question with 10 transactions and let's see how these 10 transactions will affect the accounting equation. So we know is asset is equal to capital plus liability. So I have made a table, transaction number, description, and the categories of the assets, and a column for capital and 2 columns for liability, so creditor and payable. We will see how each transaction will affect the accounting equation. To make it simple, I am doing the equation in thousands. The first transaction is owner invested 500,000. So what they are meaning here is owner has invested 500,000 by cash. When owner invests 500,000, what will happen to cash? Always think from a cash point of view. It is very easy. The cash is coming into the business. Business is receiving cash. When business receives cash, cash will increase. So here owner is investing 500,000. So cash will increase by 500,000. So we can go to the cash column and enter 500,000. At the same time, when owner is investing, the owner will have a residual interest towards the business. That is called ownership or capital. So when he invests 500,000, at the same time, owner will have ownership worth 500,000. So ownership means capital. So capital will also increase by 500,000. What we know is asset is equal to capital plus liability. In this transaction, cash is increasing by 500,000 and capital is also increasing by 500,000. Cash is an asset, so asset is increasing by 500,000. Capital is also increasing by 500,000. If we take this transaction, asset is equal to capital. The second transaction is purchased goods for cash 75,000 and for credit 25,000. Here what they are meaning is the business has bought good for 100,000. Out of that 100,000, 75,000 is for cash purchase and the remaining 25,000 is for credit. So purchasing means we are buying goods with the intention of reselling. So always think from a cash point of view. What is happening? They are purchased for 75,000. So cash 75,000, cash is going out of the business. When cash is going out of the business, we can minus cash by 75,000. At the same time, we are buying 25,000 worth goods for credit. So when we buy goods for credit, we will have something called creditor or payable. It is also known as payable. So which means it is the business obligation to repay that 25,000. So the creditor will increase by 25,000. So I am minusing 75,000 from cash column and adding 25,000 to the creditor column. We have bought 75,000 for cash and 25,000 for credit. So what will happen to our inventory? Inventory will increase by 100,000 because we have bought 75,000 for cash and 25,000 for credit. 75 and plus 25 is equal to 100,000. So we know inventory is increasing by 100,000. So we can go to the inventory column and add 100,000. What we know is asset is equal to capital plus liability. So if we set off the asset, total assets, inventory asset is increasing by 100,000 and cash asset is decreasing by 75,000. So we know cash in as a net, cash asset is increasing by 25,000 and the liability is increasing by 25,000. So 25,000 is equal to 25,000. So the equation is balancing. So always check for each and every transaction whether it is balancing or not before moving to the next question. So let's move to the next question. Cash sales 40,000, cost of goods 25,000. Now think what will happen when you make a sale. Think of a simple grocery shop. You are going to the shop. From customer's point of view, customer will go to the shop, pay the amount of money take the goods and come. From business point of view, business will receive money from the customer and give the goods. So here sales amount is 40,000 cash sales. The customer will come and give 40,000 to the business. So the business will receive 40,000. 40,000 worth cash is coming into the business. 40,000 worth cash is increasing. So we can go to the cash column and add 40,000. So what is happening to the business? To make that sale of 40,000, we have to give goods worth 25,000. So our inventory, or another term for inventory is goods, will reduce by 25,000. So when we receive cash, we have to give goods. So goods is going out of the business. When it's going out of the business, we have to minus it. So we can go to the inventory column and minus 25,000. When we are making a sale, it is very important to calculate the profit and add to the capital column. If we only take inventory and cash, let's say cash is coming in by 40,000, inventory is going out by 40,000. Cash asset is increasing by 40,000, inventory asset is decreasing by 25,000. So if we take only the asset, the equation is not balancing. So what we have to do in this kind of transaction is we have to calculate the profit and manually add to the capital column. We are selling 25,000 worth goods for 40,000 and we are making a profit of 15,000. Because it's a profit, we are adding it to the capital. So we can go to the capital column and add 15,000. So now we know cash asset is increasing by 40,000, inventory asset is decreasing by 25,000. So as a net, asset is increasing by 15,000. At the same time, capital is increasing by 15,000 because of profit. So asset is equal to capital plus liability. This equation is balancing. The important point here is to identify the profit or loss and manually add it. If it's a profit, we will add to the capital column. At the same time, if it is a loss, we will deduct it from the capital column. If we are selling at the cost, then no adjustment will be made to the capital column. Let's say in this example, if we sell these 25,000 worth goods for 25,000, then no adjustment will be made to the capital column because cash asset will increase by 25,000 and inventory asset will decrease by 25,000. Let's say we are selling the same 25,000 worth goods for 20,000, then cash asset will increase by 20,000, inventory asset will decrease by 25,000 and capital will decrease by 5,000 because of the loss made. If you have any questions or doubts, please comment. So let's move to the next transaction. Purchased furniture for 100,000. Furniture is a non-current asset because we can use it for more than one financial year. When we are buying a furniture, always think from a cash point of view. We have to go to a furniture shop. The business has to pay 100,000 worth cash. Cash is going out of the business. When cash goes out of the business, cash will decrease by 100,000. So we can go to the cash column and deduct 100,000. When we pay that 100,000, we will receive furniture worth 100,000. The 100,000 worth furniture is coming into the business. So we can go to the furniture column and add 100,000. Here cash asset is decreasing by 100,000 and furniture asset is increasing by 100,000. So the net impact is 0, no adjustment to capital or liability. So asset is equal to capital plus liability. In the equation we can say 0 is equal to 0. So the equation is balancing. So let's move to the next question. Paid creditors 15,000. So in the previous transaction we have purchased goods worth 25,000 for credit. So now here we are settling a part of it. So when we are settling to the creditors, means we have to pay cash to the creditor. Cash is going out of the business. So when cash goes out of the business, we have to minus the cash. Here we are paying 15,000. So we can go to the cash column and minus 15,000. When we settle, what will happen to our creditors balance? Earlier we had to settle, we had an obligation to settle 25,000. Out of that 25,000, now we are settling 15,000. So the obligation also has to reduce. So we can go to the creditors column and deduct 15,000. Cash asset is reducing by 15,000. Liability is also reducing by 15,000. So the equation is balancing. So we can move to the next question. Insurance paid 5,000. What is insurance? Insurance is an expense to the business. So earlier when we made a sale, we made a profit and we add that profit component to capital. Now here insurance means it is an expense. So we have to deduct that expense from capital column. So all think from a cash perspective. When you're paying for insurance, the cash is going out of the business. When cash is going out of the business, we can go to cash column and minus 5,000. Because insurance is an expense, we can go to capital column and minus 5,000. What we know is asset is equal to capital plus liability. Here cash asset is reducing by 5,000 and capital is also reducing by 5,000 because of an expense. So minus 5,000 is equal to minus 5,000. Why are we reducing expense from capital column? Because the difference between the income and expense is profit or loss. So the profit or loss is absorbed by the owners. So any transaction relating to owners are adjusted in the capital column. So because of this 5,000 expense worth 5,000, owner's profit will reduce by 5,000. So that is the reason why we are reducing 5,000 from capital column. So now let's move to the next question. Transaction number 7. Purchased equipment for owner's personal use 15,000. What's happening here is the business is buying equipments worth 15,000 not for the business purpose but for the owner's personal use. When owners takes money or stocks from the business, we call it drawings. Here the owner is not directly taking resources from the business. Instead, business is paying for his personal expenses. So it is a drawing. So think from a cash point of view, business has to buy equipment for owner. So what is happening to business cash? Business cash is going out by 15,000. Cash is reducing by 15,000. So we can go to the cash column and minus 15,000. The owner is taking 15,000 from the business. So his ownership will also reduce by 15,000. When the ownership is reducing, we have to deduct 15,000 from capital column because all owners related matters are adjusted in the capital column. So when there is a drawing, we have to deduct from capital. Here the business is paying by cash, so we are reducing cash column by 15,000. So cash asset is reducing by 15,000 and capital is reducing by 15,000. Minus 15,000 is equal to minus 15,000. Let's say in your exam, the examiner may say owners taking inventory or goods worth 5,000 from the business. Then capital column will reduce by 5,000 and inventory of goods will also reduce by 5,000. So here the business is paying cash, so we are reducing the cash. So now let's move to the 8th transaction. Electricity expense 3,000, paid only 2,000. So the expense is 3,000, we are paying only 2,000, which means we have to pay 1,000 later. Always think from a cash perspective. Here we are paying only 2,000. So 2,000 worth cash is going out of the business. When cash goes out of the business, where we have to deduct it from cash. So we can deduct it from the cash column. Earlier we learned expense will affect profit and it is adjusted in the capital column. So we have paid only 2,000 but the expense is 3,000. So we have to go to the capital column and deduct 3000, not 2000, because we have to pay the balance 1000 later. So here cash asset is reducing by 2000, capital is reducing by 3000 because of an expense. At the same time, this creates a liability to the business because the business has to pay 1000 later. So we can go to liability, and under electricity payable we can add 1000 because it's business's obligation to pay that 1000 later. So cash asset is reducing by 2000, capital is reducing by 3000, and liability is increasing by 1000. So asset is equal to capital plus liability. Minus 2 is the net of asset. Net of capital and liability is also minus 2. So minus 2 is equal to minus 2. The equation is balancing. The next transaction is credit sale 30,000, cost of goods 14,000. When we are selling, the goods are going out of the business. So what's happening to the inventory? 14,000 worth inventory is going out of the business. So we can go to the inventory column and minus 14,000. Here, because it's a credit sale, we are not getting the cash. So we will have something called a debtor balance or trade receivable. It's another term. So we can go to the debtor balance and add 30,000. So the debtor will pay us that 30,000 later. So we are making a sale worth 30,000 and the cost of those goods are 14,000. So we know we have to adjust the profit or loss to the capital account. Here we are making a profit worth 16,000. So we can go to the capital column and add 16,000 to it. So inventory asset is reducing by 14,000. Debtor asset is 30,000. So the net of assets is 16,000. Capital is increased by 16,000 because of the profit. So 16,000 is equal to 16,000. The transaction is balancing. The last transaction is rent paid in advance 2,000. Here we are paying the rent expense for the next month, not for the current month. So when we are paying, what is happening? Cash is going out of the business. So we can go to the cash column and minus 2,000. Normally when there is an expense, we deduct it from the capital column. Here we are not deducting because this is not rent expense. Here we are paying in advance. We are paying next month's rent. Because we are paying the next month rent now itself, we don't have to pay this 2,000 rent in the next month. So we can create an asset called rent paid in advance. So we can go to the rent paid in advance column and add 2,000. Here we have discussed 10 transactions. Now let's see how we are going to balance it. Now I have taken all 10 transactions to one separate slide. So this is how it will look. So the total of furniture column is 100,000. Total of inventory column is 61,000. Total of debtor is 30,000. Rent paid in advance 2,000. Cash is 326,000. Capital column is 508,000. Creditor balance is 10,000. Electricity payable is 1,000. So now I'm taking all the totals to a different slide. So if we can add all the assets will come to 519,000. Capital will come to 508,000. Liability is coming to 11,000. If we add liability and capital, it will come to 519,000. We know asset is equal to capital plus liability, and here 519,000 is equal to 519,000. So if you made any mistake in any of the transaction, this will not balance. If you have any questions or doubts, please comment below. Thank you very much.